Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today we're going to discuss stock repair with ratio spreads. Do you have a stock that's down in value and you don't necessarily want to buy more of it, but you think it might come back? Well, today we're going to talk about an option trading strategy designed to help you create double leverage, assuming you hold everything until expiration without any additional risk. So normally what we like to do is set up a risk reward graph so you can see things more visually. In today's example, we're going to show things more numerically because we feel it's a little bit easier to understand this trade along those lines. So this can be used as a stock repair strategy, meaning a stock's down in value and you want to say create a little bit more leverage because it's down and you want to see it get back sooner. Or what you can do is you can just buy the stock initially and you can create double leverage at no extra cost. And that's what we want to show you today. So once again, this is used as a stock repair strategy very frequently. Let's say you bought at 55, it goes to 50 and you want to lower your cost basis, let's say, or you buy it at 60, it goes to 50 and you want to make your break-even point 55 instead of 60. There's ways with which you can do that. For sake of a simple explanation, we're going to assume that you just buy the stock at 50 and you think it can go to 55 and you don't really see it going that much past 55. And so what this is going to do is show you a way with which you can create double leverage from 50 to 55, but you give everything up on the upside afterwards. Let's take a look. XYZ stock is trading at $50 a share. You can see in the upper right-hand corner. So let's buy 100 shares of stock. The 50 call is trading at $4 per contract. So let's buy one call option. There's our double leverage right there. Unfortunately, it costs $4 for that privilege. So in order to finance the double leverage, we're going to sell not one, but two 55 calls. Now, what that'll create is a covered call with one of the 55 calls, and that'll create a call spread with the other 55 call. If you're not familiar with call spreads and covered calls, I would suggest watching those videos before digging any deeper into this one. Also, in terms of time frame, this can work for many time frames. It may not work in some stocks, it might work in others, but if you're interested in what time frame would be best for you, I'd like to suggest our time frame selection video. So let's see how this would work. This is under the assumption that you hold everything until expiration. If you get out sooner, it's not going to work this clean and simple. But if you hold till expiration, these are what the numbers mathematically have to be. Now, let's assume the stock stays at 50. Well, you don't make any money on the stock. It's break even. You can see on the table there, the 50 call would expire worthless, so you're out $4. The 55 calls also expire at worthless, so that will cancel it out. Remember, you sold two of them. 2 plus 2 is 4. And so when doing that, the 55 calls will cancel out the 50 calls and you break even on the trade. Now, if the stock were to go lower, those call options would still expire worthless and it would be break even, but you would lose money on the stock just as you normally would. So that's what happens if the stock goes lower or stays the same. But now let's say the stock makes money. If the stock is at 51 per share at expiration, then you make $1 on the stock. You can see on the table right there. You'll only lose $3 on the 50 call because it'll be worth $1 at expiration when you paid $4 for it. But you'll get $4 in credit from those 55 calls, giving you a $2 overall gain on the trade. So instead of just owning the stock, you'd have a $1 gain. However, within this ratio spread, you have a $2 gain. Now let's fast forward and skip to see if the stock is at 53 at expiration. The stock makes $3 going from 50 to 53. The 50 call now only loses $1, meaning you bought it at 4. Now it's at 3 at expiration, because if it's at 53, it's $3 in the money, and that's what it would be at expiration. The 55 calls still expire worthless. So now you make $6 total on the trade. Instead of 3, you make 6. Now let's say it goes to 55. Well, you'll make $5 on the stock. You'll actually profit $1 on the 50 calls because you bought it 4. It'll be worth 5 at expiration. and the 55 calls would still expire worthless in theory. It's that close. You do have pin risk at expiration, but let's just keep things simple for right now and assume that they expire worthless. So on the stock, you make $5, but on this option strategy, you make 10. Now 56, let's say it goes higher. This is where the disadvantage of this trade starts to come in. You can see that you'll make $6 on the stock. You'll make $2 on the 50 calls because they'll be at $6 per contract. So right there, you have an $8 profit. But now on those 55 calls, you're only going to have a $2 profit. And the reason for that is that you sold them for $4 per contract, but now you're not making as much money, and you can see that everything kind of cancels each other out. And that's kind of how it will work. And everything will cancel each other out the higher you go. So no matter what, whether it's at 55 or 155 or any point in between, the most you can possibly make on this trade is $10. So with that in mind, anything above 60, because that's how you would normally make $10, anything above 60, you'd have been better off just owning the stock. Anything between 50 and 60, you're better off doing this trade. And anything below 50, you're at break even. And break even for having done this ratio spread combined with it, not break even because you would lose money on the stock itself if it's below 50. If you enjoyed today's presentation, please subscribe. That's how we get our content out to more people. If you're looking for a financial advisor who uses ratio spreads in a variety of ways, feel free to look me up, stcharleswealth.com. You can set an appointment. I can give you a call or send you an email, whatever the case may be. Also, please follow me on Twitter. I try to put out a lot of content. Thank you and have a wonderful day.